Okay guys, so let's look at adding additional weight to your trade. So this could come within your trade grading depending on how you wanted to set things up. But ultimately, what we want to do with this is we want to assess other things that are out there, other conditions, other aspects, other variables, and say, you know what, that adds additional weight to the trade, additional reason to take the trade, or additional grading criteria, which means we might trade it with a bigger position size. So let's have a look. We're going to go through kind of each one of these as we go, but the first one is unexpected response. We'll talk about this in a second, but how to trade when there's confusion around price response to a catalyst. So if there's really strong bullish news, but price doesn't go up, you know what happens. We'll look at that one. And then expected responses is bullish news goes up and the price does move. So it's the price response to a catalyst. Notice these are all price action trading strategies, guys. We're all looking at how price responds to something, whether that is the external catalyst, in this case, in an unexpected way or an expected way. 3, we're looking at social media. So social media obviously growing day by day. Tools and strategies and methods that we can gain insights into the emotion of the trade counterparty. Now, this is only applies for a specific segment, a specific kind of trade section, if you like, a specific type of market section, but it's useful nevertheless. 4, number short squeeze. One of my very favorite ones is how to identify when a trade is in a short squeeze. Number 5 is when they've got heavy retail trader involvement, so spotting dumb money, inverted commas, and capitalizing on a heavy percentage of gambling retail traders. And the psychology of the crowd. So the psychology of the crowd is using the news flow to determine kind of the greed or the fear, and then maybe identifying potential triggers that might kick them in or out of that trade. Okay, so unexpected response. This is one of my favorite ones. I know I say that quite often because I'm just giving you my favorite stuff and my best stuff, but it really is. So unexpected response is this, guys. It's when price moves in an unexpected manner in relation to the news that comes out. So in other words, let's say we have news that's bullish. Now, we don't have to be an economist, don't have to be an analyst. We can see the way media writes it. You can see how people perceive it. Great news, they beat earnings, the interest rates have done this, whatever it may be, whatever that piece of news, whether it is economic data, whether it is, company specific data, whatever that may be, harvest. If it's good news, then it's good news. We know it's good news. Now, if that, you would expect that good news would be bullish for the asset. So let's use the simple example, earnings. Earnings have beaten expectations, earnings forward guidance is up. There's no bad news in that earnings call whatsoever. It's good, better than everyone expected. It should be pushing that price solidly up 2, 3, 4, if not 5%, right? Unexpected response is when price doesn't do the response we expect, hence unexpected. So when price is down, let's say, after good news, what is that telling us? Well, guys, as price action traders, it's giving us that glimpse under the bonnet of the market into the engine bay and is saying, listen, if price can't go higher when we've got the very best news possible, when the heck can it go higher? We've just had great news come out that suggested this, this, and this. Everyone said it's bullish and price is going down. That is price action red alert, because we've got this response to price. Price action is how price responds to certain events or certain levels. The event is, wow, major bullish news. Price is not moving in an upward direction, in fact it's going down. What will it take for that to go up? What do you want to do from that? Yes, guys, that's exactly what we want to do. We want to be on the short side of that. At the very least, we don't want to be on the long side of it, because we get 2 things here. Number 1, it creates confusion, i.e. traders are like, oh, I can't believe this. This is the best news ever and it's going down. I'm buying more, I'm buying more. And it adds more fuel into the fire. But reality is, for whatever reason, bigger money has decided that it's a good time to sell. If you think about why this happens, okay, and because I've thought about this a lot and I've kind of written loads of articles for myself and this in my journaling, that if you think about this, a bigger player, time frame player, that hedge fund, mutual fund, big, someone who's got a lot of stock, would be in this asset for a long amount of time, in this stock for a long amount of time. Now let's say that the earnings, they've been in it, it's doing very well, the earnings now come out exceptionally good. That might well be the catalyst for them personally to say, you know what, we've had 6 or 7 good earnings cycles. I've had this stock for kind of 5 years. I believe that this is a good opportunity to sell into this strength. Okay, or sell into this perceived strength. And so that's when they might exit the trade. And they might say, you know what, we'll just sell it into this strength, get out of the trade and move on to the next thing. And so that's often, if you get a group of people doing that, that's why you're going to get this unexpected response. So you get confusion when everyone's buying it thinking it's great, thinking, well, you know, trading's easy, right? If it's good news, I buy it. And of course, that does happen, and we do get what's called expected response, which we'll look at in a second. But the very best thing is when everyone's like, hang on a second, that's really good news. And if it can't go up on good news, we are getting a glimpse again, guys, into getting X-ray goggles on, saying, hey, we're getting good news that's influencing the market, and still there's more supply that's aggressive than there is demand. This thing is going lower. So unexpected response is super, super powerful, guys. Keep an eye out for that when price basically moves the wrong way. And obviously if it's bearish news and it goes up, it's super, super bullish for that. And you know, one thing to add before we move on to expected response is that you could use this on its own as your own filtering criteria. You could quite rightly say, well, actually, you know what, I'm going to scan the earnings. I'm going to use some sort of filtering criteria for earnings or for these kind of influences on the markets I'm watching. And in actual fact, what I'm going to do is I'm going to see whether I can mark the earnings as good or bad or neutral. If they're neutral, and you know, forget about it completely. But if it's good or bad, I'm going to see kind of a price response. And you could also use that as a momentum ignition type play, or you could use it adding additional weight to the trade as well. So expected response is just price moving the right way, if you like. So bullish news comes out, it goes up. Bearish news comes out, it goes down. And it gives you more confidence to pull the trigger on any potential trade setup, because it's kind of past the test, if you like. So the test is, you know, what's the underlying sentiment of this? Well, we've got good news coming in, we're going up. That means that it's reacting as we expect. So if it does that, then you can think, well, actually that's good because I'm bullish, I'm long, I'm expecting this, or it's part of my filter, I'm waiting for a trigger or whatever it may be. It gives you a little bit more confidence to add extra weight to the trade. But going back to unexpected response, briefly while I think about it, you know, the very best thing is look, an intraday reversal. When you've had good news, stocks kind of gapped up, moved up, then it changes and reverses, goes to the low and closes at lows. So not only have you got unexpected response on your side, you've also got that intraday trend reversal. So you've got everything adding up on your side. And if you can find a kind of an extra trigger into that, you're onto a winner.